Welcome to Stock Shots. Today is Sunday, June the 7th, 2009. Let me apologize. My last video, I accidentally misstated the date. I said it was June the 30th. Somebody called me on it. But today is Sunday, June the 7th. Let's take a quick look at what numbers we got this past week. Now, I won't cover the unemployment. I think everybody knows pretty much what went on in unemployment there. We'll wrap that up into our projections, but for now we'll talk about the ISM manufacturing index, which rose 2.7. It's still below 50, which indicates contraction. However, their new order gauge shot up to 51.5, which is the highest reading since November of 2007. Probably the most significant thing that I saw this week is just a continued decline in the price of treasuries, which means your interest rates, as defined by the free markets, not by the Fed, are going up almost daily. The mainstream media would have you believe the story that, oh man, people are risk appetite is back, people are pulling money out of treasuries. The truth is, the professional traders know what this government has done. They know they've spent. They know that causes inflation, and they know that as interest rates rise, the price of those treasuries are going to fall. So what value is a supposedly safe haven asset when it's going to drop in price? Come on, I mean, that's ridiculous. But again, that's something that the mainstream media will throw out at you, and I bet if you turn on the TV tonight, you'll see something to that effect. But I think it's people dumping U.S. government debt in favor of things like commodities and maybe even some short-term plays on some of the equities such as Freeport-McMoran, those that actually own stuff. Let's take a look at the money multiplier, because I think it tells a huge story. The money multiplier the last week of May, which was the last one that I could get off the St. Louis Fed website, was sitting at 0.867. It dropped below 1.5 in October of 2008. It dropped below 1 for the first time in December 2008. Here we sit at 0.867. Now, why am I so ingrained in the money multiplier? Well, aren't you hearing the mainstream media and the Fed telling you that things are beginning to recover? Aren't you seeing interest rates as defined by the pre-market, by the free market, going up? Well, your money multiplier is at an all-time low. So shouldn't that be deflationary, you would say? Come on, Stock Shots has been preaching inflation, and look, the money multiplier proves that it's deflation. No, that's not right. That's quite the contrary. You see some signs of economic recovery with the money multiplier at an all-time low. It tells you the volume of money that's out there. If we can have recovery with the money multiplier at an all-time low, 0.86, what's going to happen when it increases? And part of the reason why the money multiplier has fallen is because of all the fear-mongering that we've had out of two administrations. Bush did it. He wanted to get his TARP money passed. Obama's done it. He wanted to get his stimulus passed. Now, if you take into account that by all government numbers, they contend that not enough of their stimulus money is yet in the economy, what in the world is going to happen when the money multiplier starts to creep back up? The money multiplier will start to creep back up as the government gets off of the panic mode, and it will. You're already seeing it. Consumer confidence is coming back up. This is a hyperinflationary mix, friends. You can say that it's a good scenario. It's not. It's the calm before the storm, and you're looking at hyperinflation. Now, I differ from a lot of people, and I'm going to give you something to think about in terms of housing. Now, you've heard a lot of the deflation people argue that you cannot have inflation until the housing market recovers. You hear a lot of people saying we're at the bottom in terms of housing. Well, we have phenomenons like stagflation, where you've got inflation and the economy's not growing. Let's take a look at what's going to happen when the mortgage rates head sky high, because it's already out of the gate. Whether you want to believe it or not, interest rates are fixing to move much higher in terms that the Fed at some point is going to have to come out and raise rates. Mortgage rates are going to go up. The housing market has not recovered, and I think when you see rates start to creep up, look, we know we got in the housing mess because people didn't care the value of the house. They didn't care. They weren't looking at what they were paying per square foot. They were simply looking at what they could afford. So they were looking at the note. What is my monthly note going to be? Well, when interest rates go up, you're going to get less house. So it's going to be tough for us to work our way out of this housing market crisis, and that's why I see real estate being a problem on a go-forward basis. So you say, hey, even by some of the people that you interview, you can't have inflation. They would tell you that you can't have inflation until the housing market returns. Well, you can have inflation because you've had unprecedented amounts of money printed. Not just here in the U.S., but all over the world. So China is already beginning to see their stimulus pay off because they didn't finance theirs, they had reserves. You are seeing pressure put on commodities prices. You have a toxic mix for our country, and it's very scary. I think we've got to see the Fed do something to pull some of this TALF and some of these things that they did to inject money into the system. We've got to see them pull it back out, or we're in trouble. I can't stress this enough. You've seen all this money printed. You're going to see inflation. We know that our economy is still slow to grow, and look at the job market. So the question is not are we going to have stagflation, but how long is it going to last? Well, if you throw a bad housing market, tough housing prices in on top of that, by virtue of the fact that your rates are going to continue to go up, you've got a terrible mix. So what do? I think we've got to raise rates. I think we've got to protect the dollar. We're seeing the dollar begin its decline. We know that, it's an absolute given fact that as the dollar declines, you're going to see the price of oil go up. We've seen no real appetite. People said, 70 would be the top. We were playing around with 70. I think that we're headed into a mess. How do you play it? I think you go to gold, and people laugh at me every time I do that, but I think you will see gold. Gold has always been a currency in and of itself, but I think now probably that currency is going to beg more of a premium as a currency because you've got a lot of trashy currencies out there. Go to preservecapitalism.com, listen to Jim Rogers talk about not knowing which currency will implode first. I heard him talking about the currency crisis, and somebody said, which currency goes first? He said, I don't know. And I think that's an accurate statement. We saw the dollar stay strong longer than I thought it would about 6-8 months ago, simply because it was better than a lot of the other currencies out there. But given that, I think you see gold get an inflation premium. I think you see gold get a strong currency premium. So a lot of people have laughed at me. They say gold can't get and stay over $1,000. I think once it breaks through at this time, it's going to have pretty good support at that $1,000 level. So again, a lot of people don't subscribe to my theories, but I do see a toxic mix. I do see us being on the verge of collapse, and I think we've got to do what we have to do to protect our dollar. If we don't do that, you could see rampant hyperinflation, housing prices that just fall off a cliff, and then where do we go from there? Let me know your thoughts. Thanks for listening.